Are you a high income entrepreneur looking for a bigger tax break? One husband and wife team contribute over 500,000 to a tax deferred retirement plan, potentially reducing their current taxes by more than 200,000. If this is something that's interesting to you, stay tuned. You're not going to want to miss this.
Hello, welcome into Legacy Beyond Wealth. Glad to see you. I am Ben George. He's Rob Shelton at Axio Wealth Management. And today we're talking about, an issue that faces many successful business owners, right? You create a high income, that creates a big problem on the tax side, right? A big tax bill. It's a good problem to have, but one that you would like to work around, especially, if it limits you also in the area of retirement planning and be able to put money and allocate money that way as well. So we're going to talk about that today in this video. Again, if you have any questions for us, we'd love to hear from you, AxioWM.com. But Rob, you want to explain today the strategy that helped one client contribute more than $500,000 as life kind of adjusted and life changed. So I want you to kind of explain this cash balance plan that we're going to talk about today.
Yeah, you bet. At its core, it's an employer-sponsored retirement plan. Want to get real technical, it's a defined benefit plan or a pension, but it communicates the benefit through a hypothetical account balance. So each year, the plan credits a benefit under a formula plus an interest credit. So really what it nuts and bolts of it in plain English is it feels and looks a lot like a 401k statement, but it's governed a little bit different than a typical 401k out there.
Okay, I know most people are familiar with the 401k, obviously. So what's the biggest difference between this and the 401k?
Yeah, with the 401k, the contribution is defined and the future results depend largely on what gets contributed and how the investments perform over time. But with a cash balance plan, the retirement benefit is defined by a formula that's out there. And there's a professional that we use called an actuary that works backwards to determine the contribution needed to support the benefit that's needed to be paid out. And that distinction matters a lot because the contributions can sometimes be substantially larger when someone puts into it than a 401k alone, especially if they're older, highly compensated owner with a strong, predictable cash flow.
All right. So I think a lot of times when business owners hear that phrase larger contribution, Rob, they often think about, okay, well, maybe that means a larger deduction. Is that really the biggest appeal here?
It gets a lot of attention, that's for sure. So when you think about employer contributions, they are generally tax deductible, and they have to satisfy certain rules and regulations, and that's why we want to have professionals come in and make sure that you qualify for all of that. But with the deduction, I wouldn't have that necessarily be the only reason to get into a cash balance plan. I think there's some important questions here. Do you want to be able to move a meaningful amount of money from kind of your business balance sheet into a long-term retirement plan? And can the company reasonably support that kind of commitment that you're looking at? So the tax benefit should serve the plan, just not become the plan in and of itself.
Okay. Who tends to be the best fit? I know people that listen to this kind of wonder, okay, is this what makes sense for me? Just generally speaking, who does this work best for?
Yeah, great question. Often it's a profitable professional practice or a closely held company with owners who are close to retirement or have a stable earnings and they're already maxing out their 401k benefit that's there, and they're looking to accelerate those retirement savings. And you have to remember, there's no shortcut based on profession or income alone. So employee demographics do matter. The owner's age also matters, and compensation does. So I think as we look at this, we want to make sure that it all comes together using different professionals to make sure we get the recommended outcome that you're looking for. That's why I never recommend people go on this at their own. This is something that you really want to have a group of professionals working together, kind of like we have with our virtual family office we've talked about quite a bit before, Ben. And that's why I recommend setting up a discovery meeting with us so we can review the specifics to make sure people really understand kind of what the benefits are and what the gotchas are, and make sure it's the best fit for their situation.
Yeah, and you can always get in touch. There's all the contact information is in the show description, whether you're watching on YouTube or listening on your favorite podcasting app. You'll find it right there. It's very simple to get in touch and begin that discovery call process. All right, you're always good, Rob, at kind of walking us through real life examples of people you've worked with to kind of help this make a little bit more sense to people that maybe haven't gone through this before. So do you have an example today that you can share with us?
Yeah, we've just finished the second year funding for a cash balance plan that we set up. It was a referral coming to us from a current client. He owned an S corporation with his wife, and in 2024, the business had a high income year with just over $1 million in net income. And we coordinated this cash balance plan with their 401k and got all the professionals involved. And they determined that they could fund this combined husband and wife at 533,000 a year.
So you're talking about more than a $500,000 here, Rob. That's a pretty significant amount of money. What does that mean from a tax planning standpoint, though? Because I know that question always comes up.
Yeah, so if you take a look at this case study, they were in about a 37% federal tax bracket and about a 4.5% Utah tax bracket. So when we looked at that, that came out to be just over 221,000 in tax deferral savings that they'll be able to have. And it's really important to emphasize tax deferral because this isn't a promise that the tax vanished away, but they were going to defer this to a future year. But even more important, it gives them control on how they pull those out in future years. So when they're in a high income tax bracket, they may be able to pull this money out in a future tax year with the right type of planning when they're in a lot lower tax bracket.
Well, so what's your role, Rob, and Axio's role in this process when somebody's doing this, besides saying, hey, here's a retirement plan that might lower the taxes for you?
Yeah, I think our role is really about coordination. And I think a lot of it like building a bridge. The wealth strategy is on one side and the business and tax strategy are on the other. The CPA understands the returns and the tax positions. You get other professionals that really understand what's going on. But what our job is getting it from one side of the bridge to the other, making sure everything fits together and all the professionals are working together. So a lot of times you can see it being technically work on paper, but it could be a really poor fit if it's going to leave the business being cash poor or conflicts with other things that the family wants to do. So our job is to take that broader approach to it, see the bigger picture, and then make sure that we have all the calculations put together with the professionals and that we execute in the right way to really make it a benefit for the family.
And that broader view is important, right? I mean, a lot of times that's really the value of working with a professional team like yourself and Axio, and really being able to kind of pull back and see that full picture, because I'm sure, the next year probably proved that mattered a lot, right?
It did. In this example, remember in 2024, 1 million in net income. The next year was really different. They got hammered with the impacts of the tariff legislation or issues that came up in 2024 through the executive orders. And that really changed that business structure quite a bit. And they had a lot less coming in. What we were able to do is tweak some things involved with their compensation, and working with these professionals, we're able to say, okay, they can't afford to be putting away over 500,000 a year, but they could be able to afford to put just under 250,000 away. And so that allowed us to really customize it by changing different things as part of the plan and having these professionals being coordinated. It's about a 54% less funding than the prior year, but it also still gave them approximately $60,000 of tax savings in that single year. So still a good tax benefit, but that's the idea of having a coordinated plan and making sure we're being proactive about it and not painting somebody into a corner. And this is an example where this was really a good fit for this client.
Does it matter what the investments are? I mean, you talked about the investment results here. What kind of strategy do you try to use from that aspect?
It's a great question. A lot of people will do a cash balance plan and they're not familiar with how the calculations work. And so very important that we're sensitive to that. We want to make sure that this is a more conservative to moderately conservative investments, because it can really affect and have a lot of risk on the back end in future years. And so having all these professionals tied in, kind of having an objective rate of return that we're trying to target and that we're able to hit that pretty close to that mark each year is pretty important. That's why working with, a coordinated group of professionals really matters when using a sophisticated strategy like cash balance plans.
Are you ready to unlock the freedom to live your best life? Schedule your no-cost 60-minute discovery meeting with our team today. During this session, we'll take the time to understand your family's story and financial dreams. Together, we'll craft a personalized roadmap designed to help you achieve your goals. Let's explore how we can unlock the freedom for you and your family to thrive. Just click the link in the description of today's show to get started.
Well, I know there's always got to be some kind of a trade-off, right? Or there's always risks involved with anything we talk about here. So what do business owners need to know with this cash balance plan in terms of risks and trade-offs before they decide anything?
Yeah, first and foremost, this is not a casual year-end election. This is a commitment that you want to have ongoing. Next, we need to take a look at what eligible employees are there and who would receive benefits and the testing. And then there's some complexity and expense that we need to take a look at. And fourth, but not least, is marketing and funding risks that are out there. And how do we make sure all of those things are taken into consideration? That's really why we want to make sure that before anyone implements this strategy, they come in for a discovery meeting and we take a look at that broader picture and make sure they just don't look at the benefits, but also the risks associated with it. And those risks are worth taking on for what they're looking to be able to accomplish.
And what about age? Does age make a difference here in this conversation?
It does. It can make a big difference that's out there. And that's where we want to be able to use this actuary that's out there that can be able to look at it. We do have some younger professionals that this does work for, but typically the older you are, the bigger the benefit or the more money you can be able to put away if you're looking at that from a tax deferral standpoint. But, you'll hear me hit this up again and again, Ben. That's why it's so important that we sit down and go through a discovery meeting with a professional that really understands the specifics of these so they can look at it and make sure you understand how and what implications there's going to be and not just the potential tax benefits that are there.
Yeah, well, anybody that decides to take you up on that discovery call and to start discussing this or whatever, whatever's on their mind in terms of this cash balance plan and maybe some of their goals moving forward, what do they need to have ready? What's the biggest thing they need to bring to that first conversation you have?
Yeah, I think the first thing they need to have is just a good understanding of their employees. And most people get that, right? We have what we call a census that's out there. Typically, they do that for health insurance and other benefits that are out there, but just about a spreadsheet of the employees, how long they've worked there, their age, their compensation. All of that will help us give the ability to kind of jump in and be able to do an assessment to see if this is the right strategy for a client.
All right, very good. Well, as we kind of close this out, Rob, what's the main kind of takeaway or lesson from this story and this idea of the cash balance plan, this strategy?
Yeah, I think the lesson isn't that they just simply contributed $533,000 in a single year. The lesson is that the strategy matched two very different seasons. We had one that was very high, and no one really foresaw the huge impacts that tariffs would have the following year. But having this plan built upon flexibility, a team of professionals that were well coordinated could really pivot and do a 54% reduction in what they had to put in the next year. And, good planning is not about forcing the same answer every year. It's about building a structure that supports life and the businesses, the results that you actually have.
All right, we'll close it out on that note. I know these cash balance plans can create some powerful retirement and tax planning opportunities, but as always, reach out to Axio Wealth Management or a financial professional to really discuss the real value there and really figuring out how this works for you and your company. But thanks for walking us through it, Rob, and thanks for being a part of another episode of Legacy Beyond Wealth. We'll talk to you again soon. Take care.
Thanks, Ben.